can I invite Michael to present the paper titled intriguingly, Waiting on a Friend, Firm Strategic Interactions and Corporate Investment. The discussant for this paper is Rick, who's also here with us. Michael, the floor is yours.
Great, thank you. Can everybody hear me okay?
Yes.
Awesome. All right, I'm going to try and share the portion of my screen that's important here. Does that work for everybody?
Yes.
Yes.
Great, thanks. Well, thank you, Susan, for including our paper on the program. It's a very new paper. In fact, you can see the title has already changed, and as we've already let Rick know that we've done a major revision since submitting. So your comments and feedback are really timely for us. So again, we appreciate being on the program, and we look forward to the feedback. Rick, thank you for agreeing to discuss our paper. So yes, our paper is called Waiting on a Friend, which suggests a little bit about what we're going to find in this paper. But just to get us started, I think the way we want to start is thinking about how information is spilled over, right? And really this starts with corporate decisions, right? So these decisions convey information, right? So think about building a new plant, divesting from an industry, entering a new market, paying dividends. All of these types of corporate decisions reveals portions of a firm's private information set to its peers, right? To its competitors. And then in turn, their peers use this information to adjust their own behavior, right? And this is well documented to impact lots of things, right? From investment decisions, corporate innovation, to financial policies like dividends and capital structure. Okay, what we have in mind for our paper is very similar, but slightly and importantly different, right? And that is, do peer information spillovers affect firms' decisions even before this information is revealed? Right, and I'm going to be really specific here in a few slides about what we mean by that. And then we go on and say, if it does, then how does it, right? What are the channels through which this information spillover is going to affect firm decisions? Okay, this is the first time presenting, so in case and in the likelihood that I don't finish all of our slides, I want to preview our results, right? And so we think we can describe most of the paper with this one figure, right? So you can think of this as a Kaplan-Meier survivor function for two different groups. The blue line tracks groups that have at least one peer in the same area, geographic region, right, in which they can learn from. And the line in red here has no peers that a firm can learn from. And what we see is a very stark difference in the survivor likelihood or the survivorship probability of a firm's project, right? So those that have the opportunity to learn from the peers in the same geographic region delay investment, or what we think of as exercise likelihood of a real option, much longer than those that don't have the opportunity to learn from their peers, right? So to try and quantify this, if we look at the 25th percentile of projects, which is about the median of those that end up exercising over our sample, we get a delay of about 14 months when a firm can learn from its peers. Right, so a fairly substantial delay. Okay, well, another way to look at this is a standard deviation in the quantity of information that is expected to be released by a firm's peers decreases project exercise likelihood by about 13%. Okay, now we do see some things in the cross section and in investigating this relationship further. For example, there's a diminishing marginal impact of additional information. Right, so as we continue to increase the amount of information that we expect to learn from, eventually this starts to taper off, right? The information environment gets saturated and firms use this, or this impacts firms' decisions less and less as we add more, right? And then we do investigate the channels. Like I said, we find that our results are concentrated in projects where there's more uncertainty about the ultimate outcome. We find it's concentrated when firms are especially skilled, or excuse me, their peers are especially skilled. And we find it concentrated in projects that are more similar. And time permitting, I'll be more specific about each of these things. And finally, we're going to exploit random variation and coordination costs as an instrument for the amount of firms that sort of cluster around a firm project, right? So the amount of peers in the same region. Okay, so the paper is really motivated from theory. There's a really nice paper by Chamley and Gale in Econometrica back in 1994 that really provides the backbone of our study. So I'm going to briefly describe their model and how that impacts sort of our empirical setup. Okay, so their model is a war of attrition, right, in which each agent is endowed with a real option, right, and the payoff of this option is risky, right? It's not necessarily profitable, but it is correlated with the agent's private information, and this private information is only released upon exercise of that real option. Okay, so there's two main features of this model that really help us facilitate a tight link between their theory and our empirics. And the first is the firm's incentive to delay their own exercise grows with the amount of information that they expect to be released. And the second is the quantity of information that they expect to be released is increasing in the number of peers' real options. Okay, so you can think of it sort of loosely as this picture, right? So this is one example. The blue is a firm's own project, and then the red are peers' real options that they expect they can learn from in the future. Right, so this would be one example, and this would be a second altogether, right? And what this model says is essentially example 2 here. There's more information expected to be released simply because there's more peer options in the surrounding geographic region. Okay, so in equilibrium, Chamley and Gale find that firms delay exercising their own options as they wait to observe their peers' decisions, right, and their peers' outcomes from those decisions. Okay, so I want to be really clear here. There's a really important feature of this. This is proposition 4 in their paper. You can essentially think as the left-hand part of that as the value of exercising after waiting an additional period, in which psi there is the amount of information expected to be released next period. Okay, so what they find is there are states of the world in which even the discounted value of waiting to exercise, given some information set that they expect to be released, is greater than the value of exercising today, even when exercising today is valuable, right? So it's not just that the firms are delaying poor projects. It's that even when they expect ex ante these projects to be profitable right now if I exercise, they wait because of the added exercise value of getting that additional information from their peers, right? And this can happen through better informed decisions, a reduction in uncertainty, and other factors such as that. Okay, so our setting is oil and gas, right? So we're going to use shale, oil and gas wells in Oklahoma and Louisiana in the period of 2005 to 2020. Okay, so I'm going to be specific about what exactly types of projects we're looking at, but for now, just think of these as horizontal infill wells. We have almost 9,000 distinct options that we're going to follow through time across 450 firms, which gives us about a 540,000 option month observations that we're going to track in our panel. Okay, so why oil and gas? And the big thing, with what we study is it offers a number of advantages in this real option setting and in this information setting that's going to help us identify exactly what we're looking to disentangle. Okay, so the first is oil and gas wells have homogeneous investments, right? They share a simple production technology in terms of drilling. They have the same natural resource that they're exposed to, which is the oil and gas. And this really facilitates a reasonable comparison across projects. Okay, there's detailed information available at the project level, right? It's not often that we get to see this type of granularity in a firm's investment opportunity set and the investments that they actually choose to undertake. So we can see things like production and drilling costs, the precise location of the investment, et cetera. Okay. The third feature of our empirical setting that's really advantageous is the rectangular survey method. Okay, so this is used in Oklahoma and Louisiana, which are the two states that we focus on in our analysis. Okay, so the main empirical advantage here is that the rectangular survey method, as opposed to a different method, right? So in Texas, they used most of the deeds were done through a Spanish deed grant. Okay, notice that in Louisiana, as compared to Texas, this rectangular survey method created 1 by 1 mile squares called sections in each township of these states, right? So this is really going to be nice versus this patchwork of irregular land formations in identifying what types of wells are a brand new firm option or those that are actually the exercise of an option. So I'm going to be a little bit more specific in just a couple of slides on that. Okay. The main thing that we want to focus on here is infill wells. Now, an infill well is the second well drilled on one plot of land. Okay, so if you look at this picture, these are all wells that are drilled on these 1 mile by 1 mile sections. Okay, so anytime you see a section with 2 wells, the second well that was drilled on that section is called an infill well. Okay, so that's the option that we want to consider here in our study is the date that infill well is actually drilled. Okay, anytime you see a section with just 1 well, we call this held by production. Okay, so this is essentially the oil and gas firm has leased the land, they've drilled an initial well, and that's going to hold that section of land available in terms of their lease until that first well stops production. Okay, so we're going to measure the option in our data as anytime there's a held by production section, which has 1 well, and it's going to be a real option up until the point it's exercised when that infill well is drilled, the second well of the section. Okay, now going back to this Oklahoma and Louisiana, the second advantage of studying these 2 states is they're very simple and well-defined land regulations for oil and gas firms. That is the sort of the minimum amount of space that they need to lease in order to drill these wells. Okay, and the nice thing is it corresponds almost perfectly with a section, right? So when an oil and gas firm in Louisiana goes to lease land, they do this a section at a time. Okay, so we can think of as the section number 8 here as a section owned by the oil and gas firm, and they're going to focus their drilling on that section. Over that section, they have almost complete monopoly power. That is, no firm can come in and try and strike oil while they have their lease. And so this is going to help us sort of mute some of the other competitive forces that might be present in some of these studies. Okay, so like I said, we can observe precise beginning and ending date of our real options. The beginning date of an option is when that first well is dug, and the end of the option is when the second well is dug. Right? We think of that as the exercise date. And then we're going to be able to disentangle these pure information spillovers from other competitive forces like first mover advantage. It's going to be pretty absent in our study because of the features of these infill wells. Okay. Lastly, we have a really strong empirical advantage here in identifying peer firms, right? So we struggle with this as a literature, really identifying what it means to be a peer firm, right? The simplest you can kind of think of is using SIC codes to identify peers. But this is pretty crude, as most of us know. Usually when we use these SIC codes, we have trouble sort of disentangling a firm's competitors from those that are in the same supply chain. So we're going to use a geographic definition. Okay, so you can think of the blue dots here as wells that are drilled by my firm, and the yellow dots as those drilled by other firms surrounding me. Okay, so when we look at this blue dot here, this section in red, we're going to think of this as the project of interest. Then we're going to define peers as any that are located in this blue box, right, which extends 3 miles in every direction. Now, the choice of 3 miles is maybe a little ad hoc, but it's designed to mimic a really common land size feature called a township. Okay, so we're going to count up all of the available peer options, excluding those that are already exercised, right? So we see these 2 sections have exercised options. So we're going to count up all the yellow dots that are in a section by themselves. Okay, so in this picture, I believe there's 21 peer options that are currently available. So that's going to be our measure of the quantity of information that this blue firm expects to be released next period. Okay, so the number of available peer options in this 3 mile radius of a firm zone option. Okay, so our data is going to come from 4 main sources. The main part of our data is from drilling info, which is going to provide us well characteristics on production, drilling dates, the precise GPS location, the lateral length of the wells, and then we're going to combine that with a number of additional data sources, including public filings, regulatory documents, Bloomberg, Federal Reserve Bank of St. Louis. These documents, for example, the public filings, regulatory documents give us things like cost of drilling, whereas we get futures prices, implied volatility from Bloomberg, and the cost of capital determinants like the risk-free rate we're going to take from the FRED data at the St. Louis Federal Reserve Bank. Okay, the last 2 data sources we're going to sort of draw information from are the Bureau of Land Management and lease data, again, from Drilling Info. Okay, these are going to provide information on our instrument. Okay, so I'm going to be more specific about our IV analysis here in a minute. But what we get from this is the number of landowners in a specific geographic region. Okay, so the Bureau of Land Management in particular gives us a measure of historical land ownership fragmentation from original allotments of parcels back in the 1800s and early 1900s.
Sorry, Michael, I have a quick question.
Yeah, please.
All of this is publicly accessible data?
So it's not at least not fully publicly available, right? The drilling info data was purchased, so it's a subscription-based data. The rest is I guess you consider publicly available, including the Bureau of Land Management. This is publicly accessible data.
Okay, thank you.
Yeah, thanks. So this gives you an idea of our summary stats. I won't spend too much time on these, but it's quite interesting to look. I think a few of the main things that we can look at. The average project in our sample has about 4 unexercised investment opportunities held by its peers, and about 5 that it holds itself within that 3-mile radius. Okay. Then we have things on the value of pure wells, firm level variables, wells, well level variables, and financial market variables. So again, I'm not gonna spend too much time on some of this data, but it's there for the interested party. Okay, so for our methodology, we're going to focus on Cox proportional hazard rate models, right? So these hazard functions are not sort of really typically used, right? When we think about corporate finance applications, most people, sort of defer to the linear models, which is our workhorse. But you can see these types of models used in certain papers when trying to disentangle these timing decisions of firm investment, right? So Larry and Roberts have a paper in the JF, Tony Whitehead has a paper in the JFE, and then I have a paper in the RFS. All of these papers use these hazard rate models to try and get at timing decisions rather than quantity decisions. Okay, so if we cast our hazard function as the following here, then H of T can be interpreted as the instantaneous rate at which a firm is likely to exercise its real option now, conditional on not having exercised it up until time T. Okay, so it's essentially the probability I exercise now, right, in this one instant, given I haven't exercised it yet. Okay, so here's our baseline results from these Cox hazard models. Before I get into sort of the main results, a few things to point out. The first are the control variables we use. We sort of add these in 3 sets. The first is going to be, firm level controls that we think might impact firm exercise. This is sort of typical in these real option studies. The amount of investment opportunities that I have, cumulative number of wells drilled in the area, sort of proxies for the time varying drilling potential of the region. Firm skill is just how good I've been at drilling in the past. Right, all of these things we think impact our investment decisions now. Okay, but then we're also going to add project level controls, right, which includes some value measure of the firm's initial well, right, that well that holds the section by production. We have the peers well values, oil and gas ratio of the project, and then the cost it took to actually drill the well. And then finally, we have market level controls. Okay, I should point out that if we look at sort of the coefficients on all of these control variables, we see stuff that we would expect from sort of standard real options theory, right? So my likelihood of exercising this project of interest is decreasing in the other opportunities I have, right? The more other opportunities I have, the less likely I am to invest in this opportunity today. So that is sort of standard in terms of how we think about real options. And it's also standard in things like futures price, right? The higher the futures price, the more likely I am to exercise today, and implied volatility. If we think of this as a proxy for the volatility of the project, then option value of that is higher when implied volatility is higher, and this has us hold off on exercising today. Okay, but what we see in our sort of main variable of interest, which is the number of unexercised investment opportunities held by peers, is that a 1 standard deviation increase in peer options leads to this 13.4% reduction in exercise likelihood that I cited on our previous slides. Okay. All right. So now I think this is maybe the most important or most interesting part of our paper, right? It's pretty obvious, I think, at least most of us, that the number of peer options in a geographic region surrounding my project is not going to be randomly distributed across projects, right? So this can kind of confound analysis in a couple different ways. The first is, if we see a large number of peer options clustered around a firm's assets, it may be positively correlated with the underlying asset quality, right? The more people that are trying to get close to a certain region, the higher they think that sort of area is valued. Okay, alternatively, if we see large groups of idle or unexercised options located in close proximity to our project, this may be negatively correlated with the expected value of the project, right? It's like nobody's exercising these options. There must be some reason for that, right? And so we get this negative correlation. Ultimately, either of these is going to confound sort of any reduced form analysis. Okay, so you can kind of think of this as a classic omitted variables problem, where the omitted variable is the underlying value of the oil and gas in the ground. Okay, so what we need is an instrument, that's correlated with the number of peer options in a region, but uncorrelated with the underlying asset quality. Okay, so here we're going to exploit data on parcels deeded to settlers through multiple land grant programs enacted throughout the 1800s and early 1900s. Okay, so this is original land ownership data taken from the Bureau of Land Management. So these are two townships located in Woodward County, Oklahoma in 1910. Okay, so on the left-hand side, you can see that there's just way less landowners, right? So we have way less land ownership fragmentation on the left here, right? An individual landowner owns more of the possible area in that township. Whereas on the right, we get much more fragmentation. Okay, so I think Paul and I actually counted up the number of landowners in each of these. On the left-hand side, I think there's around 70. And on the right-hand side, I think there's around 130, right? So we get some pretty significant variation in the number of landowners on these two sections. Okay, so then the idea is this land ownership fragmentation from the 18 and 1900s is persistent, right? And there's studies that support that. And so this is going to impact coordination costs of firms today through contemporaneous land ownership fragmentation. Okay, so if you think about, trying to go into this township and buy up all the land, right, lease all the land in order to start drilling, it's going to be easier for me to coordinate across 70 landowners than it is going to be to coordinate across 130, right? So the easier it is to coordinate across landowners, the more likely it is that I'm going to buy up all these leases. Whereas the more fragmented the land is, the more likely it is that other firms are going to sneak in, right, while I'm trying to coordinate and buy up or lease up portions of this land. Okay, so the idea here is that the more fragmented land was in the 18 and 1900s, the more fragmented it is today, and the more likely it is for there to be more peer options in the region surrounding my own firm projects. Okay, so we actually see this persistence in our data. Right, so using our historical land ownership data and the contemporaneous land ownership data that we get through the lease data, we see about a 33% correlation, right, within a county. So if we use county fixed effects in a regression, historical land ownership fragmentation actually predicts or explains, about 45% of the variation in today's land ownership fragmentation. Okay, so we have a really strong relationship between these two measures. Okay, so when it comes down to it then, the main identifying assumption of using this instrumental variable is that historical land ownership is uncorrelated with the shale oil and gas value of the land. Okay, we think this is really reasonable for a couple of reasons. Okay, first, the data in that Bureau of Land Management sample was allocated via federal land grant programs, at least the majority of it, right? So you can think of this as the Homestead Act, the Indian Allotment Act, and the Scripps-Warren Acts. This accounts for almost 60% of the land allocation in our data, which should be almost completely orthogonal to the land value, right? This is just the government saying, we want to focus on expanding west. Here's some land, through these government programs. The fourth is cash entry programs. These aren't quite as exogenous maybe in terms of them not being at all related to the total land value, just because these were programs in which the government, sold land to interested parties so that they would agriculturally use the land. So again, there's some reason to believe it doesn't have a strong link with the oil and gas value of the land. Okay. Furthermore, and I think really importantly, 90% of our sample acquired their land patents prior to 1910. Okay, so if we think about when oil and gas became big in this country, this is a long, long time ago, right? So the horizontal technology for what we call as fracking, right? This didn't emerge really until 2005 and 2006, right? So we have almost no horizontal technology used prior to 2005. Okay, so if you think about land being allocated prior to 1910, this is a century prior to this technology becoming widespread. And further, if we look at just oil and gas, right, not the technology we use in horizontal wells, this really boomed in about 1905 through 1910, right? So again, we're sitting at something that is before people even really understood the value of oil and gas underneath their sort of surface rights. Okay. And finally, if we look at the correlation between our measure and a measure of the value of a first well drilled in a section, the two are completely unrelated. Okay, so this gives us, not sort of certainty in that the exclusion criteria is satisfied by our instrument, but we're pretty sure, right? It gives us a lot of reassurance anyway. Okay, so what do we see in a first stage regression? Well, we see that a 1 standard deviation increase in historical land ownership fragmentation is associated with about a 12% increase in the number of peer options. Okay, so we get a really strong empirical relationship between these two things. Okay, and this suggests, with the F-stat of 11.4, that we have a pretty strong instrument. Okay, and then in the second stage, we see something that looks really similar to our main results. That is a standard deviation increase in this instrumented number of peers leads to a 48% decrease in project exercise likelihood. Okay, now I don't have slides on this, but in our setting, it's really likely that the bias is a affirmative bias. And so the fact that our IV estimates get more negative is consistent with the idea that we're getting closer to the true value of the coefficients rather than further away from it. Hey, how am I doing on time, Susan? I'm not quite sure how I'm doing on time, and this is my first time through. So if I need to speed up, I will.
You have taken 25 minutes, but because we started a little early, you can take up to another 3 minutes, and then we have break and the discussion.
Okay.
Is that okay?
All right. Yeah, that's great. I'll go pretty quickly through the rest, just because these slides aren't super well developed yet in any case. But we do look at a number of economic channels and model extensions, theoretical model extensions to see sort of how this anticipation of pure information spillover is impacting my own exercise likelihood. So the first is this diminishing impact of additional pure options. So Chamberlain and Gale in their model, they basically find that eventually, we get this result that once we increase pure options enough, it no longer impacts sort of firms' propensity to invest, right, or to invest today. So eventually, it doesn't impact the delay. Okay, so we can't really get to exactly what their model has in mind because they take that result sort of to limit theory. But what we do is a couple of things. First, we model this as a quadratic function, right? And what we see is evidence consistent with the idea that project exercise is really concave in this anticipation of pure information, right? So this square term is positive and significant, while the underlying effect, the linear effect, is still negative and significant. Okay, so this is strongly suggestive that we don't have at least a perfectly linear relationship in the amount of anticipated information and project exercise. Okay, second, we're going to use an indicator variable for when the number of peer options is less than the sample median, right? So an indicator when peer options are less than or equal to 3. Okay, and so what this interaction does then is compares the slopes of unexercised investment opportunities from below the sample median to above. And what we see, at least in model 2 here, is that, given an additional pure option up until the sample median, where it leads to about 6.5 to 7 percentage points more delay or less likelihood to exercise than pure options above the sample median. So again, this suggests that the the first couple of peer options in a region are particularly strong in inducing this delay from firm exercise. Okay, the second thing we want to look at, and my slides aren't really well designed here, is signal quality. Okay, so there's a paper by Aslamoglu and co-authors that suggest that this sort of incentive to delay my own project exercise is going to be strongest when I have the highest uncertainty regarding the sort of the success of my own projects, right? And so when I get a stronger signal of the quality from sort of peers around me, then this is going to sort of mute that incentive to wait. Okay, and this is exactly what we see. When we interact the number of under-exercised investment opportunities in my peer with the sort of the median value of the wells in the region surrounding me, we get a strong mitigating factor here in this interaction term. Okay. The third channel we want to test is peer skill, and then I'll talk about the fourth simultaneously, and then project similarity, right? We think that firms are probably more likely to wait on peers if the peers have documented sort of success in extracting in the past. And so there's some studies that suggest this, and then there's a study by Cho and Muslu, and Tar in 2021 that suggests when projects are more similar, this incentive is going to be stronger as well. Okay, and so we see both of these in our data as well. When we split the investment opportunities held by high skill peers and low skill peers, we see the entire effect is from our high skill peers. And then when we split projects by project similarity, so this is when they're majority gas or majority oil, and as their peers have that same feature as well. Again, we see it's all in the projects that are similar rather than those that are different. Okay, I'll just wrap up by asking, does this delay really matter, right? And there's two reasons this delay could be meaningful. The first is if these are actually micro-level distortions rather than sort of just optimizing by these firms. And the second is if this actually impacts aggregate investment. Okay, so to get an idea of the costs and the benefits of this delay, we do really crude. I want to sort of highlight the fact that it's really crude, but it's a back of the envelope calculation that we think has some suggestive power. Okay, so if we think of that 14-month delay we calculated from the Kaplan-Meier figure, in our setting, the pure time value of money delay costs, for the average project in terms of its net present value is about $177,000, right? So this represents about 8% of project value is lost due to just time value of money concerns. Okay, now of course there could be benefits in waiting through reduced uncertainty or higher exercise value, right? To try and get a sense of this, we did a really simple calculation of the gain in waiting, right? The exercise value of these projects from additional months holding the option. And we see a very small value from this waiting. In fact, it's equivalent to only a gain of about $7,000 in the average project with this 14-month delay. Okay, so at least in observed costs and benefits, we see that these costs swamp the benefits. Of course, we're missing things in the benefits, right? We're having trouble identifying sort of reductions in uncertainty and other unobservable factors. Okay, so this could be looked at two ways. One, it could be looked at as the costs seem much greater than the benefits, or it could be looked at as the sort of the shadow benefits are quite high, right? This reduction in certainty is really important to firms, and they're willing to delay because of this. Okay, and secondly, does this impact aggregate investment? And we show it does, right? I'll sort of conclude here, but this aggregate investment delay, it looks like over the course of our sample, it reduces the number of barrels of oil and gas equivalent by about, I think it's by about 100 billion barrels, right? So in our sample, that's maybe it's 100 million, excuse me, 100 million barrels, which in our sample is about $5.5 or $6 billion over a 15-year sample for 2 states. So it looks like the aggregate impact on investment and production is quite large. Okay, our results are robust to a number of things, but I'll skip that for now. So in conclusion, firms anticipate this information spillover from peers and delay investment in order to learn from these peer decisions and outcomes. Okay, we exploit random variation in historical land ownership to establish a causal interpretation of these results. And we find that the incentive is most salient for projects with higher uncertainty when their underlying assets are more similar to their peers and environments in which their peers are skilled. And ultimately, we think our results can be interpreted through the lens of information disclosure. which has implications for how we structure disclosure regulations, particular when these disclosure regulations impact or have some sort of impact on disclosing things about our investment opportunity set. Thank you.
Thanks a lot, Michael. Rick, can I invite you to discuss the paper?
All right, let me turn on my video, but if there's any problem, I might turn it off later.
Sure.
Okay, thanks, Susan, for asking me to discuss this paper. And like Michael and Paul, like Michael said, this is an early paper, but it is a really neat paper, well thought out, and they've already gone through one revision. So I was very happy to read the paper. I know a little bit about this area, not as much as I would have liked to, so I have to do a little bit of background reading. So why did I really like this paper? First of all, it's a great setting to answer an interesting question. So what is the question? The question that they're trying to answer is, can a wait and see kind of an incentive effect delay investments by firms purely due to anticipation of information spillovers, which means a firm might anticipate that when other firms make their decisions, they will learn something from that. And they think that it is better to wait for the other firms to make their decisions so that I can learn. And therefore, they kind of delay making their own investment decisions. Okay? And it is sort of, this is a very interesting sort of channel or interesting sort of an economic effect. Now, the reason that they are able to answer this question is they have great data in which they can observe these real options. You can think about it as the decision to invest is a real option. In this case, it's the decision to drill an oil well. And why do you call it a real option? Because it's like an option exercise. When you decide to drill an oil well, you have to pay an initial upfront cost. Think about this like the exercise price of an option. And then you will get these stream of benefits, which you can think about the value of whatever exercising the option, I mean, the payoff from the option, basically. So that is why this is a real option. It is very much like an option exercise, like standard financial option exercise problem, where you have to decide whether to pay the exercise price right now and get the payoff, or just delay the decision and do it next period. So like an American call option, right? Now, what they have is they have great data where they can observe the timing of the start or the availability of the real option. And importantly, they can also observe the unexercised real options. So we know in corporate finance, investments are like real options because they are irreversible and so on and so forth. It's difficult to study typically this sort of a question. Why? Because you never know which investments firms could have taken but did not take, right? And that is critical to understand this, study this exercise of real options, because you must know what are the investment opportunities that the firm had which it did not take. And this setting allows them to observe that. So that is one of the main advantages of this setting and the paper. The other neat thing which they have put in the recent update, which is also very nice, is they have a smart source of exogenous variation in their main variable of interest, which is the number of peers who have wells and they hold units of land around a particular firm's unit where they have a well. And essentially, they want some exogenous variation in this, which they are able to get using land allocation that happened more than a century ago. Why? Because it's persistent. If land allocation was more fragmented a century ago, it continues to be fragmented in this century. And if land allocation is fragmented, meaning held by a lot of people, then it is more likely that different firms will pick up neighboring plots of land. And that means for a particular firm, if it has a plot of land, it is more likely that the neighboring plots of lands have been picked up by a different firm. And this is arising due to variation in land allocation that was coming from more than a century ago. So that's, again, pretty neat. So what's the main finding of the paper? The main finding is each additional real option held by a firm's peer significantly delays the firm's own investment decision. Why? Because the firm is looking to reduce uncertainty by first observing its peers' decisions. Right? So the idea is, if a firm has no peers, then it has to decide by itself whether it should invest or it should not invest. But if it has other firms which have plots of land where they could drill or not drill for oil, then the firm says, let me wait and see what they do. And based on that, I can decide whether I want to incur this initial cost of drilling the infill well. I mean, I'm ignoring some things. There is this nuance of the whole study is on infill wells, which is the second well, as Michael mentioned. So the first well has, once it is drilled, you have the right to hold on to the land as long as the first well is active. So until the first well is active, the firm which has that plot of land has the, it's basically, think about it like a lease, it has the right to drill the second well. So this second well, the right to drill the second well, is the option that we are talking about. Okay, that the firm can choose to exercise or not exercise. That's the real option. Okay, now they find that if there are lots of real options by other firms in the neighborhood, in the vicinity, then the firm delays its own real option exercise, presumably because it's looking at those firms and whether they are going to exercise their options and gain information from that. And this effect is greater when the peer firms are more skilled. And that makes sense because a more skilled firm's decisions, if your peer is more skilled, you really want to wait to see what your more skilled peer is going to do. Right? And they show some evidence, although using a different analysis, that this effect has aggregate implications. It dampens investments in aggregate, because why? Everybody is waiting for each other to make their investment decisions. So in aggregate, on average, everybody is delayed. Right? So that has aggregate investment implications. All right, so I'm going to jump to my comments. So first, what is the theoretical framework that they have in the paper? It comes from Chamberlain-Gale, Econometrica. The basic idea, I mean, Michael already explained the basic idea. Basically, peers have private information about their payoffs. Now, the peers can exercise or not. This is informative about their private information. So if I have a plot of land, I have the incentive to wait and see what they are doing, because if they exercise, that tells me the information is good. So then I will exercise. Okay, so I want to wait and see whether they are going to exercise. Okay. Now, in many settings, so what I'm going to comment on is how good is this framework a match for the empirical analysis of the paper. So that I think I'll come back to again and again. So in many settings, what happens is if somebody has private information, they would not reveal it. Why? Because there are you will be at a competitive disadvantage and so on and so forth. However, whatever gives rise to the neatness of this setting, which is there is no common pool problem, meaning it's not a common pool of oil where if you drill and you start sucking out oil, then the other guy will get less oil. So they explain that that's not the case here. You are pretty much operating in a global product market. So you cannot start drilling first, sell more, affect prices and things like that. It's a commoditized market more or less. So in many settings, the incentives as to why somebody who has private information would want to hold on to that information and make sure nobody else finds out, I don't see that here. So in other words, if I have some piece of information which is useful for me, and it is also useful for my peer, and by giving it to my peer, I see no loss for me, then one really has to think as to why will this information not be shared, right? So I may do it for free, I may do it for a fee, or I may do it just to gain goodwill, because I'm not losing anything. If I have some private information as to how good my land is, or if I've done some survey and so on and so forth. So this is what Chamley and Gale are typically talking about, the private information that helps in deciding whether to exercise or not, right? Also, there are extensions by various people who suggest that in this sort of a setting where what is going on is the decision based on private information generates externalities which are not fully internalized by the person making the decision. But if that is the case, there should be some sort of mechanisms arising for sharing or pooling the information, or maybe some markets, especially in this setting where I can just sell the information, because giving this information out doesn't harm me in any way. I mean, I can still use the information. So why would I not share it, or why would there not be mechanisms where people would just pool or share information? And this will reduce the wait and see incentive. So this is something I think the paper needs to discuss a little bit more, because especially in this setting, the obvious reasons not to share this information are not there. Now, continuing from this, what I really think is the authors could talk a little bit more about what exactly is the information that could be gained from waiting. And they do talk about two things, but I think there are three things. So the first is, if you wait, you can see whether your peer decides to drill the oil hole or not. That is the decision to exercise. Now, how could that help? This I've picked up from a paper which I'm sure the authors are very well aware of. Actually, Paul is also an author on this paper. This is RFS 2020 with Eric Gilgy and Jérôme Talliard. So in that paper, basically they say the one piece of information you can gain is just by seeing whether a peer exercises or not. How does it help? So I'll just read out. Adjacent exercise activity by peer firms could be a reflection of some private information about rock quality that that firm has, which is not yet publicly known, so that observing a peer firm exercise could cause a firm to update positively on the rock quality of the project. So what do I mean? I see a peer firm, a neighboring firm exercise a decision, exercise meaning drill an oil hole. That tells me, oh, the rock quality must be good, and the rock quality under my land is also likely to be good. So maybe I should also exercise. Okay? And this information I didn't know. So that is one kind of information I could get. The second kind of information, which I think the paper this paper does not focus on at all, but I think is potentially very important, is the action. So if a peer firm exercises, drills an oil hole, you actually get information as to what kind of hole is it drilling, how deep is it, what else it did, and so on and so forth, which can be potentially very important. So again, I'll read out, this is again from the same paper. Adjacent exercise activity could inform a firm on how to better extract reserves from its own project. Specifically, adjacent exercise projects reveal detailed information on the target depths at which the formation was drilled, which will help the firm to target their own drilling prospects better. Further, public disclosures require information to be disclosed on the mix of fracking chemicals and techniques applied to drill and complete the well. This information can then be used to determine which approach will allow the firm to extract natural gas most efficiently from their own reservoir. So The second kind of information that can be observed from peer exercise is the action, not the action of exercising, but it's not a unidimensional exercise, non-exercise, but how deep do you drill? What do you do? That could potentially be informative. The third kind of information is the outcome. So you see that the peer firm dug a hole, you know how deep they dug, and now you can observe their production. Is the hole generating gas and oil, and how much? These are the three kinds of information that one could gain from potentially weighting. So the three, again, just to summarize: the exercise decision, the action, and the outcome. Now, the Chamblier-Gale framework, I think, captures only the first one. I mean, it's written in such a way, it's largely capturing the first one. The second one, which is the action, I think is captured in other papers. For example, Zhang, which was published in RAND 1997, which is just an extension of Chamblier-Gale, but it focuses on these different actions and the action revealing information. And the third one, which the paper does take sort of recognize, which is the outcome, is the well of the peer after they dug a hole, producing a lot of oil and gas or very little oil and gas. So that's also informative. And this is basically coming from Asimoglu, which the paper does recognize. Now, it would be interesting in in regard to my first comment as to the peer doesn't have any incentive to hold on to her private information about the rock quality and so on and so forth. She could just share it for free. The point is that's not a problem. I think the paper should point out that this incentive to wait will even exist if the pre-exercise information of the peer were publicly known. Why? Because the outcome information, even the peer doesn't know. So until they dig a hole and start extracting the oil and gas, they will not know how productive that well is, right? So that information they cannot possibly share before they actually make the decision and go ahead with that project. So therefore, there will still be an incentive to wait, even if they willingly share that information about the rock quality and their survey and so on. So now, the third comment is the paper assumes that a peer in the neighborhood, if they dig a hole, whatever happens there will tell me something about what will happen on my plot of land. Now, that sounds very reasonable, but I'd like to know more. So this could be anecdotal, or they could do some analysis. I'd like to know more as to over what distances are these relevant? What aspects of the neighboring plots of land can one assume will be similar for me? Because from what I understand, these shale deposits are kind of segregated in the sense that it's not that you dig into the same pool, right? Even if they are neighboring plots of land, it's not like an aquifer. Basically, there's a lot of water below the ground, and if you dig a hole and you hit the aquifer, the neighboring guy will dig a hole and hit the same aquifer. It's not like that. So the reader needs to be clearer as to what kind of spatial correlation should we expect and over what distance, right? And also, so in this regard, either give anecdotal evidence or show some analysis in terms of spatial correlation of market values of wells, spatial correlation of productivity of wells, of the type of wells, and to what distances do these spatial correlations go, so that this justifies over what distances should we be considering the peer firms. Like, is it just 1 mile apart, 10 miles apart? What justifies that? The second thing is the decisions, like the well depths, fracking chemicals used, are these spatially correlated? If this is the case, then this is evidence of similar conditions suggestive of an incentive to wait to observe the actions. Remember, there are three kinds of information: the exercise decision, the action, and the outcome. So I'd want to see evidence of whether yes or no, incentive to observe the actions and learn from that, incentive to observe the outcomes and learn from that. I I think this can be easily done. Now, the other thing which Paul and Michael talk about in their paper a little bit, but not enough, is the effect of own options. So unlike in the theory models, in this setting, what happens is the peer, like the neighboring plots of land, can be owned by the own firm as well, right? So I think this creates some sort of economic forces that can deviate from the models, from what the typical models analyze. Why? Because suppose a firm has multiple options in a vicinity, I think they will have an incentive to exercise their first option quickly. Why? Because the first option generates information that is relevant to all the other options in the vicinity. And this, because the firm owns all these options, the firm internalizes this, right? Now, I don't know how to think about this, especially in the context of the results that the papers shows, although they focus on the peer options. It seems that own options, the number of own options in the vicinity, has a similar magnitude of effect as number of peer options, and it goes in the same direction. So I'm not sure how to think about that, and I'll come back to this in a bit, perhaps on my concluding slide. The other thing is I can see this is going to interact with how much peer options should have an effect. So for example, if I'm a firm and I have a few peers, but I own a lot of other plots of land in the neighborhood, and I'm just waiting for my peers, at some point I can say, well, I can dig my own hole and not wait for others because I have so many holes to dig, and that will generate the information that I want, which is relevant to so many plots of land in the vicinity. So I can see this interacting with the number of peer options, but how exactly, I think more thought needs to be given to this. A couple of minor comments. I see that I'll skip the first point. I'll leave it to Paul and Michael to read it later. The second is, one of the things that they look at is the value of peer options when there's greater uncertainty. And they measure uncertainty by the market value of peer wealths. Because they say it's the underlying asset quality of the firm's wealths. If they are high, then your own asset quality is likely high. I think this is conflating two things: signal value and signal quality. If you see that the wells around you are very productive, that means your signal value is high. But if you see that there is a high variance in the quality of the wells around you, then the signal quality is low. So I think there's a conflation between the first moment and the second moment. One has to do with value and one has to do with quality. And this, I think they have to be a little bit more thoughtful about. So concluding thoughts, this is a really neat setting to answer a very interesting question. What's the question? Can there be a wait and see effect in investments purely due to anticipation of information spillover? And they have a very smart source of exogenous variation for the effect they are looking for. My main thought is, based on all that I said, I think the authors could benefit from writing their own model. Now, of course, how complicated that model should be, they should decide. But if they could have a model that can actually be calibrated, that would be great. Absent that, I think it would be interesting to have a model that would include the effect of information spillovers from own options and the fact that it's your own option, so you can decide on the timing of those exercises which spills over to you, right? And that is different from waiting for somebody else to exercise their options. And the interaction of that with the number of peer options. So some model that generates some predictions on that. Also interactions with other things like the number of peer options. Is it more valuable or less valuable when oil prices are more volatile? Is it more valuable or less valuable when oil prices are very high? These sorts of things, I think, would be interesting. And if one wrote their own model by slightly extending what people have done, this would be interesting to match up with the data. But overall, it's a great paper, and I recommend that you do read it. Thanks.
Thank you, Rick. Michael, how would you like to take this? Would you like to respond to comments raised by Rick? Although I agree that that will be a conversation which will take all the time, but I thought it was very thoughtful. And at least for me, I learned as much from your presentation as Rick's presentation, or vice versa, actually. So it was great. Would you like to respond to Rick first, and then we'll open up the discussion to the floor?
Absolutely. Thank you. Rick, these are fantastic comments. Truly, thank you. And, you know, if my co-author Paul is here as well, so if he has anything to add, I welcome that. But these are all really, really good things for us to consider more deeply. You know, in particular, no mechanism, you know, the idea that there's no mechanism for sharing information, right? When there's little to lose from such a mechanism is something we need to give more thought to. You know, the things that pop into my head are sort of, you know, cheap talk, right? It's tough. It's still tough to coordinate this type of mechanism or information sharing, even if there is value in doing so, right? Because it does take coordination. In some sense, you know, you get into a prisoner's dilemma type of thing where it's like everybody would be better off if we could all agree to it, but it's tough to get each individual firm to agree to such coordination. But that's a really good thought to think about if the framework that we've developed theoretically with Chamberlain and Gale gets us as far as we need to go. And so, you know, and that helps us, you know, move into your second comment, which is about this thing that we missed a little bit with. We can learn from the action too, right? Not just the timing and the outcome, but the things that we learn in terms of what the firm is doing, how much sand and water they're using, the depth of their well. These are all important factors that are released publicly, right? As Paul's other paper with Eric and Jerome point out. So this is something that we need to do a better job of expanding on in the paper. So I totally agree there. You know, the idea that we've missed this own option thing is something Paul and I have talked about, right? And you know, right now we haven't figured out the best way to test it. You know, the idea that there's this two-handed bandit problem essentially, right? So there's a nice paper by Patrick Bolton and co-author that sort of does this strategic implementation game in which we have this multi-agent dual-handed bandit program. So problem, excuse me. So this is another nice point. We should definitely expand our discussion on this or our thought on this. You know, so we'll try and figure out a way to get at that in a little more depth as well. I'm sure I'm missing some of your great comments. Rick, if you could send me your slides, I would really, or Paul and I, your slides, I'd really appreciate it.
I'll do that.
These are really, really great comments in terms of helping us think through the things that we didn't expand on enough in the paper, and honestly, more tests that we could probably have as well. You know, I'm a little hesitant to call myself a good enough theorist to write my own model here. Although I do agree it would be helpful if we could get something of our own, at least written down in terms of motivating our empirics. So truly, thank you for these comments, Paul. I don't know if you have anything to add to that. Feel free. Otherwise, I'm happy to take questions as well.
Well, I mean, just a few things. Thank you very much, Rick. I mean, that's an amazing discussion. I think you went very in depth, and there's a lot of what you mentioned that we've been talking about, but we had difficulties articulate in the data. But like, given that you're making those points, I think it's worth for us to think more deeply about it, about how we can probably at least get some ways to address the data. One thing I wanted to mention about the information, we do agree with you. I think the three sources of information that you identify makes sense, and I think it's reasonable to think that there are all of those dimensions that can be affecting firms' decision to wait to learn more. What we do in this paper, and one of the reasons why we're trying to get close to Chamberlain and Gale, is that this one source of exercise on exercise is one of those sources of information, and that's the easiest to observe from firms. That's the one thing that you observe straight from off the bat. So like when the peers decide to drill, their competitors directly observe that decision. The other source of information usually lag in the data. So the regulatory requirements give firms between 30 or 90 days before disclosing this information. So it's a little bit harder to argue that they're waiting for that piece of information rather than just having the confirmation. Then their competitors have positive private beliefs about the underlying asset quality. But this is really, really good. I think, at least for exposure in the writing of the paper, I think this is something that we need to improve in the discussion. Thank you.
Thank you. And now, if there are questions on the floor, we can take these now. Actually, I just had an exposition or a suggestion, right? So it was a little stunning to me that the firms would actually wait for their peers to take action before exercising their own option. And for me, that suggested that they have the choice of waiting. So there must be cost of capital that they are incurring while they are waiting to exercise that option. And do we have a sense of and I think that's what your hazard model probably showed, which is how many days or what is the period that a firm will wait to exercise the option, and how that is influenced by the number of days that they have. Was that what the hazard displayed?
Yeah, so the hazard, the Kaplan-Meier survivor functions, they suggest for sort of the median project that it ultimately gets exercised in our sample, the cost of, or the time of delay is about 14 months. From going from no information spillover possible to at least some information spillover possible. So it's really a discrete sort of calculation, but this 14 months is costly, like you said, in terms of just time value of money. And by our calculations, it costs the average project about 8% of its value for this 14-month time delay. So of course, we're careful to point out we're not observing all the benefits, and we're probably not observing all the costs either. But the benefits, I think, especially, are more likely to be unobservable. It's hard for us to view if they really are getting sort of, other than the exercise value, if they're getting sort of other information, if we're missing that, they're just not exercising some projects, that they've learned are bad, or if they're getting a reduction in cost of capital, through this reduction in uncertainty and informed investment. These are, especially because a lot of the firms in our sample are private, these are just things that are difficult for us to observe. And so we don't take a hard stance on if this is sort of a true inefficiency, a distortion, or if, what we're documenting is the benefits, the unobserved benefits are weighting are pretty large too. It's probably somewhere in the middle, but yes.
So my thought was, you have a 15-year period, right? 2005
right.
to 2020.
Mm-hmm.
And in this period, we've seen a fair degree of volatility in both, I don't know about the US in terms of the interest rates that these firms can borrow at, but certainly in terms of the prices of the alternatives to shale and gas. And the curiosity was, is there a way to look at regimes of big changes in prices or interest rates and see whether your hazard of just the cost of waiting, it seems to me incredible that it will not change, number one, across periods of time in response to more exogenous or external factors. Number two, in terms of the size of the firms, which got me thinking, all of the 450 firms that you have in your sample, are they of similar size? Are they all local firms? Are there some which are national level firms which have access to cheaper capital versus not? And surely some of these factors must differentiate the ability to wait to get the information. And is that part of the story, and am I missing it somehow, or is that something that is useful to build into this entire exercise? Was a question that I had to ask you.
Yeah, no, that's a very good question. And one of the things that we do include in our analysis is at least a time varying cost of capital. That we get through the oil and gas betas, essentially, to estimate a CAPM for the industry, right? So this picks up some time variation in that cost of capital, but it's not going to pick up cross-sectional variation in the cost of capital. It's not estimated at the firm level, for example. So this idea that there's time periods at least where we get extreme variations in cost of capital, our models should capture. We haven't looked at the interaction of that with sort of this number of peers and the incentive to weight, but it is there sort of unconditionally. In terms of the cross section of firms we have, there's I think quite a bit of heterogeneity. So you can think of the biggest ones as being sort of national players in the oil and gas market, and then some of the smaller. And Paul, you can correct me if I'm wrong. He's a little bit more familiar with some of these intricacies that I am not in terms of the firms, especially in the sample. But I think on the other end of the spectrum, we do get sort of local players. So this is an interesting thought that we haven't at least dug into very deeply yet. Is how does the sort of variation in firm size, for example, or access to external capital impacting this incentive to weight? And I think that's a very nice comment.
Just to add something to that, I think your question is super good in the sense that it talks directly to the Chemlin-Gale model. If you look at the equation that Mike's showed in proposition 4, there is one thing in front of this value weighting operator, that is the discount rate. And so when this discount rate goes up, then the value, like the discounted value to weight for those firms, should be going down, and there's the incentive to wait and learn should go down. One difficulty that we have in the current version of the paper is that we haven't been able to collect firm-specific cost of capital. So basically, we did some tests with cost of capital that is varying at the yearly level, and we do not have enough cross-sectional variation in there to have power, and so we do not pick up any variation. But this is something that we have in mind going forward. That's a really good point.
So just to wrap up this question of mine, because I don't know the space at all, unlike Rick, who has some experience, but I was just thinking, do we see transactions between firms in terms of buying out, one firm buying out the well of another? And that's a trade-off in terms of waiting to do your own project versus seeing information from somebody else, and that increases the value to you of acquiring the well as compared with starting your own project. Does that kind of thing, is that kind of information also something that is available? Can we see it move in various states for such kinds of projects?
Yes, this is a really good question. So yeah, we do see that in the data. So from an expositional standpoint, we see that assets are being transferred between firms. If you're more interested at the data side because you want to explore other questions, we don't observe the timing of those transactions, at least in the data set that we have. When you ask the question about the source of data, about whether it's proprietary or public access, one link that I posted should give you information about which firm is acquiring which well at what point in time, but this is not something that we observe in our data set.
All right, thank you. Anybody else with questions for Michael and Paul? Okay. Thank you, everyone. That was a really fascinating paper. It's very rare that we get to go so in depth into a field meaning a sector, understanding such level of detail about the way the business is done, and get things back to strategy and investment choices. So thank you very much for having sent this paper to us. It was wonderful hearing you talk about it. And thank you, Rick, for having added to the richness of the discussion. This was brilliant.